There's something incredibly unusual happening right now over at Applied Optoelectronics, or AAOI. This is a company selling into what is arguably the single biggest investment theme on Earth right now, AI data centers. And at first glance, the numbers look completely impossible to ignore. But beneath the surface, there's this massive financial mystery that literally has the entire market divided. Welcome to This Explainer. Today we're going to break down the numbers, the business model, and the balance sheet to uncover exactly what is going on behind the scenes with AAOI. Okay, let's dive into this top-line number because it is just staggering. In Q2, AAOI posted an 86.4% jump in quarterly revenue. I mean, that is exactly the kind of explosive growth you want to see in an AI play, right? But what's even more fascinating here is that management is explicitly stating that demand for their highest-end products will outpace their actual production capacity all the way through mid-2027. Think about that. Customers are literally lining up faster than the company can physically build the products. Which naturally leads us to a big, glaring question. If you have a business where customers are begging for more products than you can possibly manufacture, why are investors suddenly getting worried? Why isn't this just a straight-line success story? Well, to really understand the anxiety here, we first need to figure out exactly what it is that AOI is selling to these rabid customers. When most of us hear AI, our brains immediately go to GPUs, right? We think of NVIDIA, AMD, the giant hyperscalers, but AAOI doesn't actually make GPUs. You see, every single AI GPU needs to communicate with thousands of other GPUs, and that creates a massive bottleneck when it comes to moving all that data. AAOI manufactures the highly sophisticated optical networking products, specifically 800G and increasingly 1.6T speeds, that allow enormous amounts of information to travel through fiber optic infrastructure. They are essentially the critical plumbing of the entire AI boom. And being the AI plumber, it has translated directly into explosive sales. Back in Q2 2025, revenue sat at roughly $103 million. But jump ahead to Q2 2026, and it rocketed up to nearly $192 million. If we zoom out just a bit to look at the 6-month view, revenue skyrocketed from around $203 million to over $343 million. By absolutely any traditional top-line metric, they are capturing this AI demand beautifully. But here is where the story gets really complicated. Negative $22.78 million. Yeah, despite exploding sales, the company posted a severe GAAP loss in the second quarter. Now, they generated around $53 million in gross profit, sure, but their operating expenses were just massive. Research and development alone ate up almost $35 million of that. It's serious whiplash, 86% revenue growth, but a multi-million-dollar GAAP loss. Let's move to and see how this builds, because that massive loss actually starts to make a lot of sense when you look at their physical footprint. AAOI isn't just sitting back and enjoying the ride. They are aggressively expanding their factory capacity to meet that crazy demand we talked about earlier. Right now, they're approaching 200,000 units per month, but their target is to manufacture roughly 650,000 units per month by the end of 2026. The property, plant, and equipment on their balance sheet surged from $376 million to over $697 million. Building out that much physical infrastructure costs an absolute fortune. Which brings us to the smoking gun of this whole situation. The one number that changes the entire narrative of this business: $600 million. AAOI has the ability to raise another $600 million through equity sales. Just imagine pouring that much external capital into a company just to keep the expansion going. For a lot of investors, seeing a number this large creates immediate, intense anxiety. Now, what's really interesting about this slide is understanding how they get that money. To raise that kind of equity, you have to issue new shares, which brings heavy dilution into play. But, dilution isn't automatically a death sentence. The real question we have to ask is, what exactly is AAOI buying with this new capital? Is this a desperate bailout to keep the lights on, or is it the necessary rocket fuel to capture a historic wave of AI demand? To figure that out, we have to verify if the underlying demand is actually real, and the data says, absolutely yes, it is. Take a look at this. 140.4% year-over-year growth, specifically in data center revenue, hitting $107.7 million in Q2. Management even noted that 800G product volume more than doubled sequentially. So the demand isn't some imaginary hype. It's aggressively real, and it's heavily concentrated right where the AI boom is happening. But here comes a very harsh reality check. Selling more units doesn't magically make a company stronger if the profit on every single unit is shrinking. In Q2, AAOI's GAAP gross margin actually dropped to 27.7%, down from 30.3% the year prior. Guys, this is the danger zone. If every additional dollar of revenue produces weaker, incremental profit, the company might not actually deserve the premium valuation that usually comes with that shiny AI label. This brings us to a concept we can call the profitability staircase. To build a truly great business, a company needs to climb these 4 steps. Step 1 is revenue growth. Step 2 is margin expansion. Step 3, earnings growth. And finally, step 4, cash generation. Now, AAOI, they are completely crushing step 1 right now. But as we just saw, they are severely struggling with step 2, which means steps 3 and 4 are still totally out of reach. The good news is, we won't have to wait very long to see if they can fix this. The stakes for the next earnings report are incredibly high. The company's Q3 guidance midpoint sits at a massive $272.5 million. That would represent roughly 42% sequential growth from Q2. The real test won't just be if they can hit that big revenue number, but whether that massive top-line jump will finally force those margins up and produce some meaningful GAAP earnings and cash flow. While we wait for those earnings to drop, we absolutely have to keep an eye on the clock, or rather the share counter. As of August, AAOI had 84.57 million shares outstanding. If they end up tapping into that $600 million equity offering we talked about, this number is going to inflate. And remember, a rapidly growing company doesn't always equal a winning stock if the share count inflates faster than the actual value being created per share. So the crucial point is understanding the heavyweight boxing match happening right now between the optimists and the pessimists. On the left side, you've got the bull case, which says that as scale increases, margins will eventually improve, those ugly GAAP losses will vanish, and that $600 million acts as pure, unadulterated growth capital. But on the right, the bear case argues that margins will stay structurally weak, their pricing power might fade, and the stock value will relentlessly dilute as the company keeps going back to the market for more cash. To navigate all this noise, you need a strict checklist. You gotta cut through the social media hype and focus purely on these 5 numbers every single quarter. 1. Revenue. Is growth actually accelerating? 2. Data center revenue. Is AI still driving the bus? 3. Gross margin. Is scale finally creating operating leverage? 4. GAAP earnings. Are we moving to real profitability? And 5. Shares outstanding. Is the company creating value faster than it creates new shares? And this brilliantly illustrates where this leaves different types of investors. Based on the source analysis, the overall rating for AAOI right now is a solid watch. For beginners, honestly, there are just too many complex moving pieces here. For growth investors with a high risk tolerance, it's a speculative buy because, let's face it, that AI demand is undeniable. Conservative investors should absolutely avoid or just watch from the sidelines, and income investors should stay far, far away because there is a flat 0% dividend yield here. Ultimately, the whole shebang comes down to this. The AI demand for optical networking is absolutely real. AOI's revenue growth is real. But can they actually turn that extraordinary demand into durable profit and strong free cash flow before they dilute the stock into oblivion? That $600 million is either going to be the fuel for incredible long-term success or the start of a very painful downward spiral. The next earnings report might just give us the answer. So what do you think? Can AOI finally turn AI demand into real profit? Thanks so much for joining me on this explainer, and whatever you do, keep your eyes on those margins.